Okay, hey everyone, welcome to another episode of The Real Estate Path. I'm your host, Jim Lee. So happy and excited to have you guys here with me. The show is all about an investor's journey. Not just the highlight reel, but the real raw path that every investor must go through to achieve the vision and their dream. Whether you are a first-time real estate investor or you're a seasoned pro, we're going to talk about the success, the wins, loss, and the lesson behind the losses so that you can be prepared as a better real estate investor. I have a special guest with me today. His name is Ross. Welcome to the show.
Thank you, Jim. Thank you. Happy to be.
Great. So Ross and I met at a real estate meetup. After that, we became friends, and he attended my real estate meetup when I hosted my own at ITI City of Industry. And ever since then, Ross and I have been just talking and brainstorming about how we can potentially find win-win scenarios here in LA and help each other make some money. So Ross, can you give us a little bit context about, how you got into real estate development in Los Angeles?
Yeah, for sure. So I guess my background is construction management. So I did that from a corporate level for about 20 years. And so for me to kind of pivot, I was already investing in some buy and hold real estate deals. But right around 2017, I was ready. I was kind of shopping for the next deal, and I was looking at price points, and I was like, $300 a square foot. That was just too much for me to kind of stomach. So I looked at it from the different perspective with my construction hat on, basically, and I started penciling things out, looking at the pricing. I was pretty sure I could do a development for about $125 a square foot. Turns out I was wrong, but I did finish that project at $151 a square foot. So that's kind of just a short spiel on how I got into my first deal. But yeah, from that first deal, then I was able to just basically sell that asset off and then roll the proceeds forward into two more deals. And then I kind of got to that point where I was like, oh my gosh, I don't have any more of my own capital. What am I going to do? So I had to, kind of put pen to paper again and get a little creative. And that's where the beauty of networking, going to the meetups that are real estate based meetups. I've just been able to meet a lot of, similarly minded folks that know real estate is the place to put their money. They know real estate is place to grow their money, put their money, secure their money. And then, from there, I've been able to work on some other development deals with some local investors.
Right. Okay. So lots of them unpack there. So you mentioned you worked in construction for years. Being in that industry and then moving into real estate, did you start out with a real estate investing portfolio, like, long-term rental, or did you just jump right into development from the construction business that you had, or the experience? Yeah,
so I bought, 2010 is when I made my first purchase. It was a condo out in Murrieta, California, and it was a passive investment. So it was kind of like, the recession had just come through. Property prices were a little bit, well, maybe not a little bit, but they were very depreciated. So that was my first investment. And then from there, I bought a duplex in Los Angeles. I got out of that one, bought another duplex in LA. And so I had I just had the two duplexes at the time. And come 2017, that's when I was ready to basically buy again, but I was kind of just scratching my head like this doesn't make sense from the price point perspective. So took the dive and did my first ground up development.
Okay. So you had what people always call the massive bull run, right? Because if you started back then, right after 2008 crash, you would do really well, if you started any type of investment back then. So you started in 2010 and then acquired a couple of units and then eventually moved into development in 2017. What was the mindset shift there? What did you see in the market that made you want to jump on so much an asset class that has so much risk? I know you had the construction background, but it's a big mindset shift, right? Like for residential investors who move into a development project, commercial development. So
yeah, I think for me, because of that corporate background, it wasn't weird, or it wasn't, I wasn't allergic to sitting down with the architect, sitting down, kind of studying different parcel maps and seeing, going to the city and seeing what can be possible. So for me, it wasn't so far away, but that's kind of what I did. I would, as I was, more and more interested in developing, you do like the Saturday or Sunday drive through different neighborhoods and see what's going on. There'd be open houses and these new developments. A lot of times the real estate agents are connected with the developers. I mean, not a foreign concept, but you can get in there, walk the property. You can kind of get some inside information on from that agent that's pretty savvy on the development side of things. And then, on some of those early open houses, the developers would actually be there. The contractors would actually be there helping just kind of promote and pitch the deals. So you get a little bit of inside information. But yeah, I think for me, it wasn't too foreign. And, come Monday morning, I was just back at work and, doing the corporate construction stuff. So for me, it just wasn't too far-fetched.
Yeah, so it's more aligned with what you were looking to accomplish. Now, in that period of bull run you had, did you learn anything? No, because the reason why I asked, I know it sounds like a funny question, because I just talked to another guest speaker the other day, and he was telling me, yeah, and during good times, you're never going to learn anything because things are good. You're making money, you're cash flowing, everything appreciating, everything is going up.
Sure.
But, it's during the bad times, during downturn, that's when you really learn, because things hits the fan. You have to figure out, okay, how can what do I do to pivot? What are my options, right? That was.
Yeah, no, I'm with you. It's hard to fail when all tides are rising, right? So, but I think, I was definitely passionate about real estate, getting into the new space, which was development. So I would just be kind of a podcast junkie, whether it was like Jake and Gino's or Bigger Pockets or Grant Cardone, on the way to work, that's what I was doing. On the way home from work, that's what I was doing. So just kind of soaking it all in. And I guess the other thing I kind of figured out, whether it was like from the podcast or just real life, was, I figured out there was a whole nother side of the world on just the tax benefits. So for me, trying to figure out, all the 1031, stuff that goes with a 1031 exchange, that was pretty eye-opening, because you can with a 1031 exchange, you don't have to pay the capital gains if you do it correctly. Trying to think what else. Cost segregation studies. I ended up doing one or two. I think I did two of those on the duplexes I had in LA at one point in time. So there's a lot of just very useful information out there to study, learn from others. And but as far as, did I learn anything? I think I learned on the development side, I learned that that's what I wanted to continue pursuing, because, I had the construction background. I love seeing just, whether it's equipment, people putting things together, that just resonates with me. And then the real estate, benefits, the holding, that also resonated with me. But I think, on the first development, I was in the city of Southgate. In the foreseeable future, I'll stick to the bigger city, call it Los Angeles. I'm not looking to go to the smaller municipalities, just because that city Southgate, they didn't really have a system in place. There was a lot of times where the plan checker would get confused, or the plan checker, I remember like following up with my architect, then I had to go down to the city after plans were submitted. They lost my plans. So it was just a awful process. But, with City of LA, they've got stuff like they scan the plans in. So they're always there. The digital record's always there. You can always retrieve them. So just simple things like that make me, want to stay in the City of LA proper, at least for the foreseeable future. And I'm sure I could probably talk all day on other little tidbits and things I've learned along the way. But yeah.
Yeah, I mean, elaborate on the city of LA. Like, why'd you decide, actually, you wanted to start in Los Angeles of all places? Because it's so difficult to get permits with regulations and getting like you said, getting your plan approved.
Yeah, I was living in Downey. Southgate was like the city right next door, and so it kind of just made sense from a proximity standpoint. Yeah. It was a foreclosed property. I forget, I paid $415 or just over $400,000 for this property. It had 27 violations, so I knew like a fix and flipper is not going to be able to come in here and just, put $35,000 worth of paint and carpet and call it good.
Yeah.
So yeah, with the number of violations, the price point of the property, I think little to no competition, it just made sense that from a development that it was the traditional knockdown house. And yeah, so went through that process, but it was not it was my first one, not a smooth process. But just you pick up little tidbits, whether it's from the architect or the contractor, even with the plan checkers down to the city, maybe them showcasing what resources they don't have. Mm-hmm. And then when you do go back and on your deal number 2, you always interview, or I would traditionally set up a few interviews with architects, and you just really get good feedback, but you'll see some similarities in that feedback. They're the messaging is kind of the same messaging, but yeah, I think for just kind of where I'm at with the level of development I'm doing, City of LA for the foreseeable future, they are, I mean, you can go on Google, you can pull up the zoning code really quick, you can pull up the zoning summary, which is just a quick snapshot of whether you're developing in commercial, residential, small multifamily, or bigger multifamily. So for me, just having that snapshot, quick at my fingertips is super important. But then going to a different municipality, I don't know, whether it was like Downey or Southgate, then you've just got to know all the intricacies with the little codes. I mean, some cities, the ADU laws are getting pretty robust nowadays, but some cities, they won't let you go to like a second floor ADU. You don't want to be shopping for knockdown houses in those cities where you're familiar with doing that here in the city of Los Angeles. So as long as you're familiar with that zoning code, I would say more power to you. But for me, with me being Los Angeles, is in our backyard, there's a number of deals in the city of LA. LA is so huge to begin with. The city has a great process. I'm not going to say it's the best out there, but I would say it's predictable. With a reputable architect, that process will be predictable, and yeah, I think just with those different components out there, it just makes more sense to kind of not reinvent the wheel with some of the smaller municipalities.
Right. What is your sweet spot? Like what from all the experience you've built up ever since 2017 till now, you got 8 years under your belt. You're still developing nowadays. I see that you're pretty active on your deal flow and the type of actually doing the development. So I wanted to ask, after all these years of experience, what have you find out there that works for you? Is it taking, let's say, for example, a small house on a big lot, convert it into 1 to 4 units, add an ADU, more of a sophisticated flipper, or are you looking for like only multifamily conversions?
So I would say the sweet spot, about 2022, I kind of saw this, or maybe just a little bit before that. But anyways, I replicated that into a project I'm doing now, and it's co-living. So what I'd say more or less my main focus is right now is, finding good sized lots in the city of LA that are zoned, like R2, RD2, R3 for small multifamily. Yeah. That allows me to go to the city. We can still submit under the residential. We're not triggering any of the commercial code, but we'll basically do a quick building envelope study, which is just, looking at your lot size. If it's a 50-foot wide lot, you can go I forget. I think you can go like 38 foot wide, depending on how high, how many stories. But you can go 38 foot wide. You check out the length of your lot, and you'll do your setbacks on the front and the back, and then you just do a height, which is the number of stories. So the density is getting pretty robust in some of these areas of Los Angeles. So right now, I'm wrapping up a 4-story duplex with an attached ADU. That'll be a total of 32 bedrooms and 32 bathrooms. And what that does is, a couple things. Probably people are out there thinking, how is this possible? But so we're basically building like these $5 or $6 million duplexes with attached ADUs. But when I'm done with the project, I'm no longer going to get like a residential loan, because the next door house that sold 6 months ago, that's not my comp. My comps are going to be looked more like a commercial property. So what I'm doing is I'm forcing the appreciation through that whole design process, doing the co-living, rent by the bedroom. And then at the end of the deal, it's more of an income approach analysis from the appraisal from the bank. And there's actually a lot of these assets in and around the USC area, traditionally for student housing. I forget, USC has like a deficit, I think, of like nearly 30,000 students. I feel like there's 51,000 students, but they've only got beds for like 17 or 20. So there's a huge deficit. So that's kind of where it started. But then with Mayor Karen Bass's Inside Safe program, whether it's, homeless, former foster care kids, there's quite a few underserved demographics. They just need housing. So we're really looking to cater more or less to that, give them that sense of community through the co-living aspect. And then at the end of the day, it's really a win-win. The investors I'm working with, kind of doing that force of appreciation through the development is really, really good. And then at the end of the day, they're building these houses for people that are part of the underserved community, and kind of a give back, giving those individuals what they need, which is that, safe, clean housing, sense of community, where they're living, and just that additional support. So,
yeah. Can you elaborate and walk us through one of these type of deal, or the current deal that you're currently working on in terms of co-living, right? Because I actually just had a guest 2 hours ago, Devin. He works for Pat Split. Yeah. And Pat Split is all about just renting by rooms, and it's a hot topic right now to combat affordability. So walk us through, like, what does this deal entail? How did you find the deal? You said you had investors, so is this a joint venture, or did you syndicate this project? What are the return on investment for these investors? And are you what's your exit strategy? Are you just looking to build to rent, or are you looking to put some tenants in it and then sell it off based on the income it produces?
Yeah, so I'm trying to think of a different deal. So earlier this year, February, we bought 2 properties in kind of the Boyle Heights area. So I'll just use maybe one of those as an example, but it's basically the same thing. So there's one, so, I get all these deals sent to me, and it's just like you're reading through, no, but every now and then you get one that's like, okay, that could be. Mm-hmm. I personally like the Boyle Heights area from a development perspective. Again, city of LA, because Boyle Heights is one of those areas that if you look on the map, you're like, oh, okay, but you've got to be careful, because there's a line of city of LA that runs through half of it, and then county's the other half. So I'm only focused on city of LA. So it's just, there was a deal that hit my inbox, and I pitched it to a husband and wife that are investors with me. And basically we went I couldn't make it, but the husband made it. He went to the showing, liked the property. We did the numbers. We sent the details over to my architect. He just kind of double checked me. But that one's going to end up being 3 stories. We're going to make the first floor, the entire ADU. The second floor will be unit 1, and the third floor is going to be unit 2. So we've got a unit 1, unit 2 kind of the upstairs units. That's our duplex with the first floor is an attached ADU. That'll achieve 35 bedrooms and 35 bathrooms. I think we have some half bathrooms for common, so it's probably like 30, whatever, 6.5. But anyways, nobody wants to share bathrooms anymore, so every bedroom has its own bathroom. And then on that deal, I think we got some smaller common bathrooms. But yeah, we picked up that deal submitted an offer, $602,000. It was an R2 lot. In the escrow process, we just did some exploratory investigation of the sewer lateral. We got a small credit, $4,000 credit. So we're into it for $598,000. We work with a mortgage broker. He'll do he's got a hard money option for us that works well, gets us secured for the first 12 months. And then that 12-month period, we come in. I mean, you can come in as low, I feel like, as 10 or 11% with some fees. But yeah, I would just expect it to be, put down 20, 25%. But I think on that particular deal, we went pretty low. So yeah, we acquired the property. We've got 12 months now to get it fully permitted. So the architect's been working on the design. Right now, it's still with the architect, between him and his structural engineer. They're just going through there's a small slope on the lot with about a 4-foot slope. So they're figuring out how to work that with, on that deal, I forgot to mention, we're going to leave one wall in place. So when we go submit to the city, it's not a new construction build, it's a major renovation. But that ties to the lot, that 4-foot slope on the lot. Anyways, people can ask me about that later. So yeah, once we're submitted to the city, I think the permitting process will go fairly quick. We submitted another major renovation in February. We're probably a month or less out on that. So July. So what is that? Like 6 months. So yeah, I think we'll probably be about a 6-month-ish approval once we get the first submittal in for that deal. And then, the the beauty of development, it's you don't need all the cash at once, right? You need money to acquire the property. You need a little bit of money to retain your architect. You've got to pay some plan check fees along the way. And then by the time you get to the end of your permitting, you're going to be RTI. Then you're going to pay a pretty significant fee. I mean, City of LA, it's not cheap to do a permit, to get a construction project going like that. You're probably into it like $70K, $90K, something like that, for the construction permit. And then after you pull that construction permit, you're going to go to your hard money lender, go shop it out. You're going to look for construction lending. They're going to appraise it off that cash flow, more of the income approach. And depending on their terms, some guys are a little more lenient than others, but I think a good rule of thumb is probably 75, 80% loan to cost is what we're seeing now. One guy we just found, he's doing like 100% of financing on construction. So that's pretty unique. That's pretty good. He won't do interest reserves. So you got to come up with interest during the life of the loan. But I mean, at the same time, having 100% financing is pretty unheard of. I've heard of like 90 and other stuff. But there's some really good terms out there on that. And yeah, at the end of the day, you can probably do the math on your calculator, but if we rent these things, we could go to a pad split alternative if we don't want to go to the the vulnerable communities, those different demographics. But I mean, yeah, we're looking to rent a bedroom per month for about $1,218 to $1,250 per month. This particular build is going to have 35 bedrooms. At the end of the day, it's going to be valued. I think that one is it's about $6.5 million, based off the income approach. And our all-in cost is going to probably be about 3.8 to 3.8 and change. So there's some significant upside on just forcing that appreciation that we're doing.
Yeah. And what's the timeline look like? Is that like a 3 to 5 years? What are you guys projecting? 5 to 7 years?
Yeah. So I tell everybody, expect it to be at least 3 years. We're going to try our damnedest to get it done in like 2.5. But we are working with agencies. you can't always predict, again, I'm here tooting the city of LA's horn saying that's where I'm staying. But yeah, some of that stuff is unpredictable. But I would say just expect it to be about 9 months for the design, that permitting process. Then I would underwrite the deal. It should not take 18 months, but I would underwrite the math for an 18-month construction period. So right there, we're at 27 months. And then a lot of people miss that there's 3 escrows. To do the acquisition, that's a month on the front end. You've got another escrow when you're switching from your acquisition loan into that construction loan. So there's another escrow. And then on the back end, getting that permanent financing, there's another escrow. So that's kind of like, that'll add up. That's 90 days minimum. So right there's 2.5 years. And then just expect, I would just expect to go into a deal saying it's 3 years.
Yeah. Okay. In terms of just when you said 35 rooms, I'm trying to picture it in my head. You said the first floor is ADU, and then you have this literally the first and the second floor. Why is it designed that way? And why would you call that very first floor ADU when it could just potentially be just another floor, 3 floors?
Or a triplex, right?
Yeah, exactly.
Yeah. It's just, I get that question occasionally. It is a triplex. That's all it is. But when you submit 3 attached dwellings to the city, you're going to trigger commercial. We do not want to trigger commercial because now the timeline is no longer 2.5, 3 years. So you want to, we're just kind of, we're in alignment with what the city of LA is requiring. But that's ultimately why we want to stay in the residential code. We don't want to trigger commercial. We don't want to, there's some premiums once you go to the commercial. Trying to think like fire alarm, fire department stuff, FDC valves, stuff like that. What else? They're probably going to require a bigger 600 amp panel, maybe an 800 amp panel. Then you got to work with LED. We don't want to do that. Right. So there's just some nuancy stuff that would trigger if we submitted it as a triplex versus using the new upgraded ADU laws. And I can't even keep track of the ADU laws anymore, but that's why you got to work with a really good architect. So that's why it's a duplex with an attached ADU.
Makes sense. Completely makes sense with the loopholes that you have to just figure out how to make your deal work. When you mentioned something interesting earlier about you don't necessarily need to come up with all the capital when it comes to development, right? You have this going on, you have X, Y, and Z, and you can take care of one thing at a time. So from my understanding, what I learned from the last downturn is not having enough cash reserves when it's needed, right? When there's shit hits the fan, you just gotta have more money, right? At the end of the day, how do you raise cash reserves according to your strategy? Like, how do you mitigate that risk if should there be a downturn and you just don't have enough capital? I'm just curious.
No, good question. So more recently, I'm coming in to the deals really with sweat equity, and then I'll partner up in that situation like with a husband and wife. They'll be more or less responsible on the capital side, and everybody's different. Some people just have that much cash laying around. Other people want to raise money as we go. Other people might just be, hey, maybe Jim, you're in charge, but you can talk to your brother and your folks have a SD IRA, or I think maybe they have like that self-directed IRA, something like that. So I'm not doing any syndications on that development deal that I'm talking about in Boyle Heights. I think we're actually, that husband and wife, they're looking to raise some capital, about $500,000. Maybe we need a little bit more than that, but on a deal that size, it's not the level to go create a fund or to go, in my mind, to start going to syndicate. It's right around or maybe just a little bit north of $500,000. And then, on the back end, there's some pretty good returns for, with that $500,000 investments. But if shit hits the fan, I don't think we'd want to be in the middle of the construction project when shit hits the fan, but you can't predict this stuff. So, when shit hits the fan, we're going to be a little bit at the mercy of the market, right?
Yeah.
But I think that's where it helps, it helps that, I'm just really focused on City of LA. Some of my other mentors, and colleagues that are doing development, I'm talking to them, seeing what they're doing, seeing what they're seeing out there as far as rates and stuff like that on the market, in the market. But then at the same time, like I mentioned, that gentleman, I forget the name of the company, they'll do 100% financing on the construction. I mean, we'll lock that in for 24 months. The construction, once we're in the construction period, I tell everybody underwrite it for about 18. But we should be done with construction probably month 13-ish, 12 or 13. And then there's going to be a little bit of time to get it stabilized, get the rooms filled. So there's a ramp up time, but 90 days should be through that ramp up time. So we should be under that 18 months. Anyways, but that guy, he would offer 24 months. So there's a little bit of grace period at the back end also.
Sure. So when we talk about the topic development, everybody thinks, that's the most risk, because you do have also the most margin if you're patient enough to weigh it out and if the construction goes according to plan, right? One of the questions I have for you is, what was a mistake that you made that you had to recover from, and how were you able to bounce back from development?
I would say, good question. So I would say, I probably got too comfortable, and I'm still, let's say, bouncing back. I'm not completely out of it yet. But on my first deal, the one I mentioned in Southgate, I got pretty comfortable with the builder, and I went to do another deal with him. And, the schedule took too long. So we're still working through the final stages of permitting. Right now, we're just waiting on the LID, low impact development, approval from the city. And then I think we got to do our fire sprinklers. But I mean, I'm still living it. It's not fun. Yeah. It's one of those things that, you've got to have capital. You've got to have capital on the side, because when your schedule's slipping, you're going to have to throw money at the problem, unfortunately. That's not ideal, but I would say do your due diligence. I think for me personally, I was at the point where I just got too comfortable. Hindsight's 2020, I mean, there's a lot of stuff out there. Whether it's Instagram, feedback on the internet. I mean, you can check people out. You can get a referral. You can look up that property I did in Southgate. You'll find my name there, and you can see who else was attached to the deal. Well, it's the hard money guy. So call up the hard money guy and say, hey, what do you think about this contractor? They'll tell you. That particular hard money guy has been in business here in SoCal, just mom and pop shop, great guy. If you want to know the reputation on contractors out there, I'd pay the hard money guy in the local. That's kind of one of the things. I mean, there's good hard money lenders, and there's good deals when it comes to like Center Street, Kiavi. But I can't pick up the phone and call Kiavi and find out if this contractor in City of LA is reputable or not. But I can call my hard money guy that's out of the mom and pop shop. And he'll just lay it out. He'll be like, Ross, be careful, or Ross, that guy is above board. He's the guy that builds my deals. So it's like, okay, I want to copy paste, and I want to use that contractor. But success leaves clues. I don't have to tell you that, but what I've learned is, just do your due diligence, and then I would say do it again. And don't forget that it's a team sport. There's a lot of resources out there, such as the hard money guy, such as the architect. When you're interviewing architects, ask them, like, have you done a deal? Have you done a development or a design like this before? Okay, thanks. Have you done work in this city before? Okay, thanks. Oh, by the way, I'm still interviewing architects. Who could you name that you would never work with in this space? They'll tell you some of the players that are, have that not so clean reputation. It's a lot of money. Don't be afraid to ask, and do a solid due diligence.
Oh, absolutely. And this is why I also am a big fan of building real estate community, because within my community, anyone who walks in, we all can do diligence on that one specific person, right? Whether has she or he done deals with us, any of us. Do they say what they say they're going to do, and all that good stuff, right? Everybody's doing due diligence amongst each other, and that's also, I think, why you attend networking event, right? It's just getting to know people and see who the real active players are, right, in the market, and really just pick their brains and see what's out there, and that's how you do your research and do your homework, right? Is there anything else you'd like to share with the audience that we haven't touched upon?
Trying to think. No, I mean, that's kind of high level of what I'm doing, what my niche and focus is right now. But yeah, I'm happy to, of course, if there's questions out there the audience has, whether it's, developing, just in general or specific to City of LA. Yeah, I'm always putting it out there. Just reach out, and I'm happy to help answer any questions or just maybe it's a connection. So
awesome. How can people find you?
Just probably Instagram. You can find me Ross Wayne 23.
Okay. Be sure to give him a follow. Thank you for your time. I appreciate you, Ross. And that concludes this episode of The Real Estate Path. We will see you next time.
Thanks.
Thank you, Ross.